Hello students, my name is Gauravbansal and we are going to start this very interesting topic which is always very relevant for the PT examination, and that is related to the repo and the related terms. So since you are into this video, I hope that you already know what is liquidity adjustment facility, what is repo and reverse repo. And for those who want to see a video on that, I will be covering repo and reverse repo, the basics, the core basics of the LAF liquidity adjustment facility in a video within next 2 days. Now in this topic, which is relatively bit advanced compared to the basic repo and reverse repo, and in this we are going to discuss some of the other related terms as well. So let us start with a very brief backgrounder on the repo and the reverse repo. So repo rate is a short of repurchase, and originally in fact we use the term repossession. So repossession means a bank will, okay, for example, a bank will give bond to RBI, and in exchange it get the funds, it gets the money, so it goes to bank. This is the first step. But since such auction or such financial transaction is called repossession, bank will repurchase the bond. This bond will go back to the bank and bank will pay the funds back to RBI. Okay, but when it will pay back the fund, it will pay that money back with some interest, and that interest is basically the repo rate. Okay, so for example, initially bank took 100 crore rupees from RBI and it took it for 14 days. After 14 days, bank repay 100.25 crore rupees. Now in this case, let us say 25 lakh rupees is the interest that the bank has paid to the RBI for taking this loan. Okay, now all of that is decided at the time of transaction itself. That is why we call such transaction repossession. Now repossession has some negative connotation with itself. So over time, actually long ago, repossession was replaced with repurchase. So this is a term that we use now, repurchase. So today repo simply means repurchase. And this is the term we read in our banks today. Now, coming back to our question, we have understood what is happening in the repo transaction. A bank which has a lot of bonds in its reserve, it gives some of the bonds to RBI, get the funds, and then after some time, it will buy its bond back. It will repurchase the bond and will pay the funds back to RBI with some interest, and that interest is decided by repo rate. So what is happening in repo? Funds go to bank, so that means money supply is increasing. Okay, money supply increase. Now money supply has increased in repo, but it has not increased on permanent basis. It has increased only on temporary basis. That is why we call it adjustment facility. Okay, repo and reverse repo together are often called liquidity adjustment facility. So why it is called adjustment? Because money supply is going to increase, but after some time it is going to decrease again. So it will come back to the original. So it was adjusted for some time and then it goes back to standard. So that is all about the repo transaction. Okay, so repo increases money supply temporarily. Now think about reverse repo. Reverse repo does the opposite. In the case of reverse repo, it is RBI. Okay, it will give the bond to bank. Okay, and from bank it will get the money, and after some time RBI will pay the money back to bank and repurchase its bond. So that is reverse. What is reversed here? The role of the bank and RBI. Now why does RBI need funds? RBI doesn't need fund. Reverse repo is purely for the purpose of monetary policy, for the purpose of decreasing money supply. In this case, Since RBI is taking money out of the system, money supply decrease. Okay, so reverse repo transactions decrease money supply, whereas repo transactions increase the money supply. So this is something we need to remember. That is the basis of the reverse repo, and together these are called liquidity adjustment facility. Now, what are these? Variable reverse repo, fixed reverse repo. So basically, in its quarterly monetary policy statement, all of us know, or I hope you know at least, that in 1 year, 4 times RBI and MPC, Monetary Policy Committee, it sits together and decides the policy rate. And then that is announced in the quarterly monetary policy statement. So every quarter RBI announces a monetary policy. In that, it announces the bank rate. Okay, it announced the repo, it announced the reserve repo, it announced the MSF, marginal standing facility, it announced the standing deposit facilities, HDF, okay, MSF. So these plus repo, reverse repo plus bank rate. So these are the 5 rates that the RBI decides. Now let me rub all the work that I have done on that page. So that you can clearly see what we are going to discuss further. Coming back to the original topic now. So we have understood that every quarter we issue monetary policy statement in which we announce repo rate, reverse repo rate. Now those rates which we announce are actually fixed. So monetary policy statement basically announce the fixed reverse repo rate. Okay. At present, this is the lowest policy rate. Similarly, in the monetary policy statement, what RBI announced is policy repo. Both of these rates are fixed and they will remain the same until the next monetary policy statement, or sometime if RBI really is very desperate to change the policy rate, it can also announce a mid-term revision. But generally RBI, since it is already very frequent at a quarter, RBI waits for the quarter. So those are announced every quarter. Fixed reverse repo and policy repo. Basically these are the fixed rates. Fixed rates are for the standard procedure. Standard procedure are 1 night, 7 days, 14 days, and in rare circumstances 28 days. So repo is up to 1 month. Repo is given for short term. Okay. Now, it is possible that a bank may need money for relatively longer term against its bond. So on that case, there can be some special conditions. Similarly, it is also possible that when RBI announced the quarterly policy, the condition was bit different, but later on the conditions changed, and accordingly RBI is also changing the monetary policy stance. So in that case, what really happens is variable reverse repo. Let us discuss this now. Variable RRR, reverse repo rate. Now, what is variable reverse repo rate? So generally the reverse repo that we discussed, in which bank basically gives money to RBI. In that case, there can be two options. Either it is fixed reserve repo rate, the standard which was announced in the monetary policy, but it is also possible that it is announced through auction. Okay. So in the case of an auction, what really will happen? Bank will target a certain interest rate, that we will charge this interest for our money. Okay. So that is also possible. So in the case where bank opt for an auction, or RBI offers an auction, then it cannot be fixed rate. Then obviously the rate is going to be decided by the auction, and that auction based reverse repo transactions are called variable reverse repo transactions. And whenever RBI feel that it wants to withdraw money from the system, it does the same. Okay. So there are two options with Reserve Bank. One is fixed, which is standard, which is already known to the banks, and banks regularly sell their bonds or buy their bonds at fixed rates, which are policy rates or fixed reserve repo rate. Now, just give me 1 second, please. So we have discussed in the case of reverse repo rate that we have either fixed or variable options. Similarly, when it comes to the repo rate, we have three options. One is policy repo, the fixed rate which is announced in the quarterly policy, the rate at which commercial banks can simply borrow money, as I explained in the beginning. So it is there to increase the money supply in the system temporarily. Now, if it is on the fixed basis, that is on the basis of policy repo, which is a fixed rate announced in the policy. But then it can also be conducted through auction. When it is conducted through auction, it is called variable reverse repo. Okay. So what is the key difference here? This is a fixed interest rate at which bank can anytime get it. Whereas these are decided by RBI. Remember it, variable, whether it is reverse repo rate or repo rate auction, it is always going to be the prerogative of RBI. RBI जब चाहेगा वो तब auction करेगा. It is the decision of RBI to offer it, whereas fix is always available. That is the key difference between the two. Okay, so I hope by now you understand the difference between the variable rate and the fixed rate. Now, what is this term repo rate? Okay, so term repo rate is also there, in which RBI can offer exception to the bank. Okay, for example, it is not based upon auction. Individual bank can offer to RBI that I want to borrow for a longer period. So, can you give me at a certain interest rate? So, RBI can offer a term repo. Term repo is a rate which is different from the monetary policy statement rate. Means the policy rate which RBI has announced. Okay, let us say the policy rate is 6.25 at present. Now, bank want to take a loan for 2 months. Okay, in the case of a 2-month loan, let us say bank offers to pay 6.5% interest instead of 6.25, which is the policy repo. So, in this case, RBI can charge higher interest from the bank and give them for longer duration as well. So in that case, since it is not the standard repo rate which was decided in the policy, it will be called term repo rate. So there are three types of option. First, which is announced in the policy, which is the policy rate at which standard operations are there, which is the standard procedure of the system in which the interest rate is fixed. Any bank anytime can take loans or give money. Similarly, there is term repo in which rate is fixed. It is not based upon auction, but it is different from the policy rate. And third is variable repo, which is based upon auction. So these are the three options. In the case of reserve, I'm saying accidentally reserve every time instead of reverse, because reverse is used rarely, whereas reserve is used a lot in our case. So as an economics teacher, we always use Reserve Bank of India, so it is bit on our tongue as well. So I hope you won't mind that. So, reverse repo rate has two variations, fixed and variable, whereas the repo rate has three variations: fixed policy repo rate, term repo rate, and variable repo rate. These are the three options. Okay, so and bank use the term repo rate, basically central bank, for a longer duration loans. So this is all about the various terms related to RBI, and I've already discussed why it is called liquidity adjustment facility, because in this case liquidity is adjusted for a short period. What is liquidity? Liquidity is simply the excess funds in financial system. If you read the technical explanation, the technical definition is the surplus of loanable funds with the financial system. Loanable funds means funds which are available for loan. Means every financial system has some funds. Okay, let us say there is a financial system in which there is money supply which is available, in which there is money demand. So the difference between money supply and money demand is called liquidity. So liquidity is positive when supply is more. Okay. And liquidity is negative when demand is more than supply. So that is the liquidity. Now, whenever we undertake repo or reverse repo auction, we are changing or adjusting the liquidity. In fact, adjusting it, not changing it. Changing it temporarily, we can say. So that is exactly happens, and that is why we called it liquidity adjustment facility. And as I discussed earlier, adjustment because the liquidity gets back to the original position after the repossession is complete. So I hope everything is now complete and you can very confidently deal with this section. So thank you. I hope this session has helped you, and we are going to take many such sessions on many technical terms in the coming time. Thank you.